Good afternoon, everyone, and good afternoon to our distinguished guests, colleagues, and partners. It's indeed a pleasure to welcome you to today's webinar on unlocking export financing, funding pathways, risk mitigation, and the future of export-led trade. We are delighted that you could join us as we explore one of the most critical enablers of global competitiveness and economic growth: access to efficient, sustainable, and innovative trade finance. We want to begin by extending our sincere thanks to our keynote speaker and distinguished panelists for lending their time and expertise to what we believe will be a very important and timely discussion. We are delighted to have each of them with us today, and we are confident that their perspective will make this session worthwhile and worth your time. As we gather together, I am reminded of the powerful observation by the former WTO Director General, Roberto Azevedo, that says trade is not just about goods and services, it's about building bridges between economies and creating opportunities for people. This sentiment captures the essence of why we are here. Global trade remains one of the most transformative forces for development, innovation, and shared prosperity. In recent years, shifting supply chains, market volatility, and evolving regulatory landscapes have reshaped how businesses operate globally. In this environment, trade finance has become more than just a transactional tool. It is now a strategic pillar for resilience, market expansion, and export growth. So, why does this conversation matter and why are we here now? Across Nigeria, there is an increasing focus on export led growth, and rightly so. The agricultural, solid minerals, manufacturing, and agro processing sectors present real and significant opportunities for economic growth in Nigeria. Yet, many businesses operating in these sectors continue to face challenges accessing the capital needed to scale their export ambitions. We have seen in some of the transactions that we've handled, and in most cases, the issue is not about the absence of capital, but the ability to structure transactions in a way that makes them bankable, in a way that gives financial institutions, developing financial institutions, and export credit agencies the confidence to participate and to support these businesses. As we gradually move towards an Africa single market in the wake of the African Continental Free Trade Area Agreement, we know that the growth potentials are there, particularly in intra-African trade. But for many businesses, realizing opportunities will require understanding the financing instruments available to them and how to structure transactions that lenders will support. So, for the next 90 minutes or so, we will be exploring how exporters and even importers can better position themselves to access financing, how financial institutions assess and manage risk in trade transactions, and how legal and policy frameworks can be leveraged to unlock both local and international capital. I encourage you all to participate actively, ask questions, share experiences, and engage with our panelists. Conversations like this strengthen our trade ecosystem and allows us to collectively unlock new export opportunities. Thank you once again for joining us, and we look forward to an engaging and insightful session. So we begin with our keynote address, which will be delivered by Architect Benedict Itebe. Architect Benedict Itebe is the regional coordinator of the Southwest Regional Office of the Nigerian Export Promotion Council, where he has served for 24 years. He oversees trade facilitation programs for the 6 Southwest states. And on the global stage, he is a United Nations Center for Trade Facilitation and Electronic Business Registered Trade Facilitation expert, contributing to several policy instruments. He is a fellow of the Chartered Institute of Corporate Administrators, member of the Nigerian Institute of Architects, and a fellow of the Artificial Intelligence Marketing and Finance Institute. He holds an MBA in International Business from Robert Gordon University, Aberdeen, and is a University of Oxford alumnus through the prestigious AIG Imukwede Foundation Public Leaders Scholarship. He is currently enrolled for a Doctor of Business Administration in Artificial Intelligence with LIGS University in the United States of America. Architect Benedict Itebe is a cocoa expert and a member of the National Cocoa Management Committee. He also represents the NCMC on the Joint Steering Committee for the development of a digitized national traceability system for Nigeria. We believe that his deep expertise in local export incentives and regulatory compliance makes him a vital authority on navigating Nigerian trade ecosystem. Architect Benedict Itebe, welcome, and I'll yield the floor for you so that you can take us through your keynote speech. Thank you.
Thank you very much. I believe I'm quite audible.
Yes, you are.
Thank you very much.
Thank you.
Without much further ado, I'd like to appreciate the Denton ACAS-Law for organizing this webinar. I extend the warm greetings and regards of the Executive Director, CEO of the Nigerian Export Promotion Council, Mrs. Noye Ayeni, on whose behalf I will be delivering this keynote address at this auspicious conversation. And I read as does. Protocol. The managing partner and distinguished partners of Denton ACAS-Law, representatives of commercial banks, export credit agencies, development financial institutions, and insurance companies, captains of industries, trade finance professionals, legal practitioners, distinguished ladies and gentlemen, good afternoon. It is a distinct honor to be invited to deliver the keynote address at this important gathering. The timing could not be more consequential. Africa is at an inflection point. Nigeria, as its most important economy, sits at the very center of that inflection. The global trade architecture is being redrawn by the pressures of supply chain realignment, by the increased urgency of the African Continental Free Trade Area implementation, by the revolutionary paradigms in digital trade architectures and emerging technologies, the importance of bilateral economic cooperation models, for example, the CEPA UAE and the CIP USA, among others. The newly launched National Industrial Policy takes cognizance of these contextual dynamics to provide the enabling policy and infrastructural framework for exporters to scale and to thrive, especially through value addition and sustainable business development. Export financing is no longer a niche discipline. It is a critical factor for Africa's economic transformation and for Nigeria's non-oil export sector to fulfill its potential, to diversify the revenue base and create dignified and inclusive employment. In order to join the ranks of trillion-dollar economies, we must build a financial ecosystem that is bold, accessible, and fit for purpose. This is precisely the conversation this webinar opens, and I commend Denton ACAS-Law for convening it. The landscape where Nigeria stands today. Nigeria's non-oil exports have grown steadily up to $6.1 billion and 8 million metric tons in 2025. From cocoa, sesame, cashew, to solid minerals like lithium, gold, aluminum, and copper, to value-added merchandise like leather goods, textiles, processed foods, pharmaceuticals, to service exports, including tourism, especially in Lagos, and the creative industry sector. We are witnessing diversification in real time. In 2025, non-oil exports crossed significant new thresholds. And the NEPC data projects that with the right enabling environment, increased export formalization and enhanced data capture, we can expect up to more than double this annual non-oil export revenue by 2030. The gap between export potential and export performance remains wide, and much of that gap is a financing gap. Profiling export finance issue. Nigeria SMEs report that access to pre-shipment and post-shipment finance remains their foremost constraint, even ahead of infrastructure and market access, infrastructure deficit. The cost of trade finance in Nigeria, driven by high interest rates, collateral requirements, and risk premiums, remains prohibitive for first-generation exporters especially. A significant proportion of export-ready enterprises struggle to compete and to complete their first international transactions because they cannot bridge the working capital cycle. Exporters with confirmed purchase orders, quality certifications, and confirmed buyers are still unable to fulfill contracts because the banking system fails to deliver. The policy architecture. Permit me to speak directly to the three pillars that must form the foundation of a financial export financing architecture for Nigeria. Pillar 1, optimization of structured export credit mechanisms. Nigeria has institutions mandated to deliver export credit support, but utilization rates of available credit lines, guarantee facilities, and risk-sharing instruments remain far below their potential. This may be partly a product design issue, also an awareness gap, and about document complexity. NEPC is committed, that's the Nigerian Export Promotion Council, is committed to working alongside development finance institutions, the Central Bank of Nigeria, and the commercial banking partners to simplify the interface between exporters and these instruments and financial windows. Pillar 2, risk mitigation as an enabler. The conversation around export risk has far for too long been dominated by the narrative that Nigeria has a high-risk financial ecosystem. Indeed, there are genuine risks in export transactions, legal, political risks, currency risks, counterparty and compliance risks. However, it is also a high growth and high return jurisdiction. Credit insurance, concessionary loans, export incentives, and structured guarantees exist precisely to unbundle these risks and make transactions bankable and scalable. The Nigerian export finance ecosystem needs a culture of proactive risk restructuring. Then, since ACAS-Law and the legal profession more broadly have a critical role to play to design systems and instruments that work. Pillar 3, technology and digital traceability as enablers. We are living through a revolution in trade technology that is strengthening the framework for risk management and export finance. Digital credentials, supply chain traceability, real-time payment tracking, and AI-driven compliance screening are now operational realities in the market that are fundamentally enhancing traceability and accessibility, critically shaping the global trade finance ecosystem. For Nigeria, this technology wave represents a transformative opportunity. An instance is the European Union Deforestation Regulation, which enters full enforcement by the end of 2026 for large operators and middle of 2027 for SMEs, is compelling our agricultural commodity exporters and value chain actors to deploy digital traceability systems. The trust infrastructure will also unlock other valorization opportunities at scale, including microfinance and insurance. Now I will speak to emerging opportunities where capital should flow. Number one, agro-processing and value-added commodities. Nigeria exports roughly $3 billion annually in unprocessed agricultural commodities. Value-added processing opportunity, cocoa butter, processed cashew, sesame oil, refined palm products, and certified organic produce will triple that figure over the next 5 years. Financing structured around processing, commodity warehouse receipts with collateral managers and commodity exchanges, as well as structured offtake agreements and export credit guarantees can unlock these opportunity segments at scale. Services exports, creative energy, economy, and digital services export. Nollywood, Afrobeats, fashion, and digital services collectively generate over $1 billion annually in foreign exchange inflow. Yet, formal trade finance structures for the creative economy remains virtually non-existent. Royalty-backed financing, intellectual property, securitization, and digital services export facilities represent exciting frontier opportunities, but for dynamic financial institutions willing to innovate and lead. Number three, solid minerals and critical raw materials, especially. Nigeria's solid minerals sector, lithium, tin, aluminum, copper, gold, precious stones, and industrial minerals sit at the intersection of Nigeria's diversification agenda and the global energy transition. With the EU's Critical Raw Materials Act creating structured demand for responsibly sourced materials, the rapidly growing sector enabled with proper licensing, environmental certification, and digital product passport for critical raw materials will continue to attract local and international investment. It will also develop export markets and support innovative project finance. Number four, manufactured goods and light industry. ECOWAS preferential trade, the AFCFTA, and the array of Nigeria's bilateral economic partnership agreements with the UAE, the USA, the UK, Brazil, China, India, and Turkey together create a multi-billion preferential market for Nigeria's manufactured goods. Textiles and garments from Abia and Kano, pharmaceutical products from Lagos and Ogun State, fast-moving consumer goods from across the Southwest have genuine export competitiveness if backed with working capital financing and via credit facilities at competitive rates. Number five, green and premium certified export products. The global sustainability premium is real and growing. Certified organic produce, sustainably sourced traceable products, niche markets such as the $3 trillion halal market present new opportunities for both price premiums and dedicated sustainability-linked financing. Nigeria's certification and traceability infrastructure is developing, and NEPC is working to accelerate it. Financiers who start to build green export products now will lead the market within 3 years when the infrastructure is mature and developed. Finally, a call to structured collaboration. I would like to be clear about our aspiration of this forum, of the legal professionals, of the financiers, the regulators, and the development finance institutions here gathered today towards scalable and sustainable financing models. To the commercial banks, we ask for trade finance products designed for the realities of Nigerian SME exporters, requiring shorter tenures, lower collateral thresholds, and embedded technical assistance to their products, financial windows. The market exists, the exporters are committed. Let's meet them with products that work for all parties. To the export credit agencies and development finance institutions, we ask for deeper partnerships in pipeline development. Together, we can co-create tailored and accessible export finance products, especially for small businesses and export cooperatives. To the insurers, we ask for proactive engagement in trade credit and risk products tailored to the Nigerian non-oil export value chain. And to the regulators, we ask for continued clarity and consistency in the regulatory framework, especially those governing trade finance and cross-border payments on the continent. And ultimately, to the legal practitioners, we ask that you bring your expertise to the table early in transaction structuring, in compliance architecture, and in the documentation of export contracts. Properly structured contracts are finance-ready contracts. In closing, I would like to express my profound confidence that the pedigree of experts and professionals partaking in this timely webinar are indeed in the best position to articulate new strategies and develop new finance solutions that will bridge the export finance gap sustainably. And therefore, I wish you all a fruitful and engaging discussion and look forward to working together on the implementation of the pragmatic roadmap that will emerge. Thank you very much.
Thank you very much. Okay, please go on.
Thank you very much, Architect Egbe. Good afternoon, everyone. My name is Temitayo Shobande, and I'm a member of the Financial Services team here at Denton's ACAS-Law. It is wonderful to have you all with us today. Thank you very much for coming. That was a truly insightful keynote, and I know I speak for everyone when I say it has set the right tone for the conversation we're going to have today. We'll be taking questions a little further on in the webinar, so please hold on to those thoughts. So before we move on to the panel session, we would like to take just a moment to understand a little bit about who is in the room with us today, virtually speaking. So you should have a quick poll appear on your screen now. Let's just give it a few seconds. Okay, so it should be on your screen now. I hope everyone can see it. Please take a moment to cast your votes. It will take only a second. And it would help us make sure that, today's conversation is as relevant as possible to you and the work that you do. So please take a moment to fill the poll. The question says, which category best describes your organization? Is it a commercial or merchant bank? Is it DFI or government agency? Are you an exporter or in the real sector business, or legal or consulting firm, or any other category? So please take a moment to fill the poll. Thank you. Please keep them coming. Okay. Okay, so I see we have a rich cross-section of participants today. We have participants in every category, actually. So we have banks, DFIs, exporters, advisors, and others. So I think that diversity in the room is itself a reflection of how interconnected the export finance ecosystem really is. Every one of you sees a different part of the same challenge, and that makes for a much richer conversation. So let us make the most of it. While I still have your attention, we have a second poll that will be putting up shortly. Okay, so now you should have on your screen a poll on the main barriers to export finance. So I guess now that we know who is in the room, we really want to hear about the real world and the challenges that everyone is facing in their different areas of work. We know that export finance can be transformative, but practitioners across the continent consistently tell us that there are stubborn barriers standing in the way. So this second poll is just to get a feel of what everyone thinks about the barriers that they are experiencing in their own area of work. So you can only pick one, as you know, so pick the one that comes to your mind first, please. Okay, so I'll just give a few more seconds for that. Thank you very much. Thank you very much for your active participation. I see a lot of people have chosen different answers. Okay. So we see that the votes are spread across multiple barriers, which I think is itself a powerful finding. It tells us that there is no single silver bullet as such. The barriers to export finance are systemic, and they are mutually reinforcing. So even if you solve the cost of capital problem, there's still the collateral and compliance constraints which remain. So I think that kind of multi-layered challenge calls for coordinated solutions, and is exactly why we're having this conversation today. So I won't take more of your time. We'll have two more polls later on in the session, but I'll hand over to Doc now. Thank you very much.
Thank you very much, Tammy. Good afternoon, everyone. I think I'd want to say a special thank you to, the keynote speaker, Mrs. Nonya Ayeni, Executive Director and Chief Executive Officer of the Nigerian Export Council, represented here ably by Architect Tegbe. I think your presentation has helped us frame the discussion more deeply, and it will then make sense for us to then delve into the conversation, right? But before we do that, I think for me, a couple of themes, right? A few things can be distilled from your presentation, sir. First is that the opportunity is clear, and Nigeria's export base is diversified. We're seeing diversification across different sectors, unlike what it used to be in the past, where it was just oil. The second is that there is, I mean, the gap is not opportunity, but actually financing, right? And of course, risk, which is one of the biggest determinant of capital flow, is to be structured, not avoided. For me, this sort of captures the theme of the message that NEPC has shared with us today. The question really then becomes, how do we translate these insights into transactions that actually gets done? How do we get the deal done, right? I think this would be the most appropriate time to bring in our panelists to unpack this from different perspectives across the export finance ecosystem. I will then introduce our panelists, starting with Scott Brumbo of Elevate Export Finance. Scott is the CFO at Elevate Export Finance, a Canadian-based financial services firm focused on providing foreign buyer financing solutions that enable exports to expand into international markets. In this role, he oversees the operational and financial governance of the firm's business and loan portfolio, supporting the structuring and execution of export finance transactions for global buyers. Scott brings an invaluable international perspective to today's panel because he offers insights into what global ECAs and international lenders look for before deploying capital. And I hope that we're going to have a rich conversation on the basis of his experience playing in that sector. We also have the privilege of having Yemi Sioni, who's the Chief Legal Counsel at Africa Development Bank Group, on the panel. Yemi Sioni is a seasoned legal and financial professional, finance professional, I beg your pardon, with extensive experience advising on complex cross-border transactions across global financial centers and emerging markets. She currently serves as the Chief Legal Counsel at the AFDB, where she advises on debt and private equity transactions, as well as a range of institutional and strategic matters within the bank's operations. Yemi has an LLB from the University of Kent, an LLM from the University of Warwick, and an executive MBA from the London Business School. She's a member of the Nigerian Bar Association and the Law Society of England and Wales. Yemi enjoys teaching others how to build impactful networks, and I believe that she'll be sharing insights with us today on not just impactful networks, but also how financing is done, at least from a legal perspective. Sharing perspectives from AFDB's, from her role at the AFDB. Stephen Gray is also on our panel. We have the privilege to have him on the panel. Stephen is an officer of the Order of the British Empire, by the way, and he heads the West and Central Africa office of the UKEF. That's the United Kingdom Export Finance. He's a distinguished trade finance expert with over 30 years of experience, specializing in emerging markets and infrastructure development. Steve is a distinguished trade finance. Oh, sorry. So his experience spans across Africa and the Middle East. Steve leads the UK government's efforts to facilitate trade through innovative financing solutions, including sovereign guarantees and direct lending. His extensive on-the-ground experience across West Africa, including markets such as Nigeria, combined with his deep understanding of the legal and compliance frameworks required to make projects bankable, makes him an authoritative voice on the future direction of export-led trade and international risk. I should say congratulations to Steve on the recent transaction with Nigeria, where they're guaranteeing well over £600 million in funding for the Nigerian ports, the ports in Apapa and then Tinkan. Last but not the least is Dr. David Okpeyemi-Oke, who is the Vice President of the World Trade Center in Lagos and the Head of Trade Services at the World Trade Center, Abuja. David is a development strategist, trade facilitator, and private sector leader committed to shaping a more prosperous, competitive, and integrated Africa. Over the past decade, his work has spanned cross-border trade, policy advocacy, youth development, investment facilitation, and institution building. His work includes leading WTC Abuja's trade service strategy, securing global partnerships, shaping export programs, and facilitating over $150 million in investment and trade inquiries, supporting legislative engagement championing regulatory reforms and contributing to Nigeria's domestication and operationalization of the Africa Continental Free Trade Area. I can go on and on and on to speak about what David does, but I think he has distinguished himself as an expert in the subject matter that we're set to discuss today. So having said that, I would like to start with David. David, I'll start with you. And I would like to find out from you, from the vantage point where you sit, what do you consider to be Nigeria's export readiness today? And where do you think the biggest gaps between the potential and actual performance is? I mean, listening to Architect Itegbe of NEPC, it is clear that there are potentials, but do those potentials translate to actual performance? It'll be good to hear from you what you think about the export readiness of Nigeria today is. Thank you.
Thank you. Thank you very much. Confirm to me that you can hear me, please.
We can hear you loud and clear.
Thank you. I want to thank the management of Denton for having me. It's such a great pleasure to be sharing platform with great minds. And of course, Architect Benedict, it's nice to see you. And I must commend the work you're doing, and of course with Madam Nonia Ayeni for the work you're doing at NEPC, to continue to drive non-oil export. However, from your presentation, which I listened to, and I think Dr. Sanford did a very good job at, summarizing it, Nigeria does not have, export potential problem. That is established. Of course, we have a population of over 240 million people, which is a very large market size. We have, over 60% of our lands arable. We have vast natural deposits, vast natural resources deposits, across all the sub-region of Nigeria. And of course, like we say in the space, we say almost every local government in Nigeria has an exportable product. If you look at also the demographic advantage that we have, having 60% of our population, younger than the age of 20 or 25, you see that we stand a very great chance, of at the continent level when it comes to non-oil export. But if you look at this, if we consider, if you look at the potential vis-a-vis the reality that we have on ground, our exports, our non-oil exports still remains at about less than $6 billion, as a last report. And if you compare it to, countries like Vietnam, that is doing about $350 billion annually, and you look at maybe Bangladesh and other, countries that have similar economic indices with us, you'd realize that we are not, fully harnessing the potentials that we have. So when I say we are ready, no, I don't think we are. However, we cannot say that we can't, ignore the political will of the current government as well to see how they can drive, non-oil export. And I mean, that's speaks to what we are seeing now. We are seeing multiple bilateral trade agreements. We've seen SEPA with the Middle East. We've seen the recent UK state visit, and we see the potential that has for us, in terms of, helping us to reach that market access, which has been a major problem. But the question has always been, has it really been about market access? Because, the gaps still remain that, we have over 36 million, registered businesses in Nigeria. And as at the last, record that I have, I think NEPC can correct me, we have less than 2,000 registered exporters in Nigeria. And how many of these exporters are really active? In November of 2024, there was a convening of the top 100 exporters in Nigeria. And it broke my heart to see that, of the top 100 exporters, among the youth demography that we claim, that we brag about as our advantage, there is not a single person that is a young grade of top 100 exporters. So question is, what is the future of export if we have that demographic advantage and we're not leveraging it, to drive inclusive growth and sustainable development, driving non-oil export in Nigeria. So we still have issues of standard gaps, many SMEs are unable to produce to meet, the standard for the international market. I'm not even still speaking about AFCFTA just yet. Hopefully, we get to talk about it during the conversation. And we see that across even the West African sub-region, ETLS has been operational for as long as you can think of. AFCFTA became operational by January 6, 2021. And you see that the standard required in Nigeria is different from that is required in Benin Republic and in Ghana and all of that. And you see that there is serious disjointment, in the harmonization of standard, across, the continent. And of course, Nigeria is not even producing to meet the standard, and of course, there's still market access gap as well. It's easy to talk about ECOWAS. It's easy to talk about, AFCFTA. It's easy to also analyze our relationship with Europe. But have we considered, the bottlenecks that we have in, facilitating this, market access, and how SMEs and people can actually have access, to them. So there is limited integration of our businesses into, the global value chains. And, finally, I'll talk about, logistics and port inefficiency. Thank you, Steve, for the work you're doing in helping us to, improve on our infrastructure. And hopefully, we can continue to improve. It's better than it used to be. I used to work at the NPA, and I see the bottlenecks an average exporter face, trying to move their goods across, out of Nigeria. If you want to see how terrible it is, take a trip from Nigeria to Ghana through road, and you see how difficult it is. And of course, we are also unable to really manage, diplomatic relations well. Since 2018, the Nigerian-Benin border has been shut, December 2018, and we've not been able to resolve this issue. Imagine that we're talking about export, we have ETLS, there's liberation of goods, free movement of goods and persons, and we are closing border against each other. So now, if you're going to export from Nigeria to Ghana, Benin is giving you a mandatory transit fee of 8 million CFA, which is equivalent to almost 20 million naira per truck. And if you look at that, build that into your cost, how competitive are you going to be at the, at the point of destination? There are a lot of issues we can talk about, So really and truly, Dr. Sanford, we are underperforming relative to our potential, and the data makes it very clear. And I hope that at the end of this conversation, NEPC can take feedback, and of course, maybe Denton and every other partner in this place, we can take feedback, and put, maybe policy advice together to work with, critical, partners across, that play within the game. On the 27th of March, we launched the national single window. Hopefully, it works this time. But if you look at it over the years, we have seen series of innovation and initiative, advanced cargo correction scheme in 2010. We've seen Valentina in 2002 try to see what we can do to reduce documentation and the requirement at the port, to reduce the bottlenecks, to reduce the congestion at our seaport, and of course on our roads as well. We've seen improvements in infrastructure, but we hope that we can continue to improve on this, and then this way we can create an enabling environment for businesses to even think about doing business across the border, and of course, we can, financing is there, which is the major gap. I don't know why I forgot about that, which is we're talking about. Financing is there. The cost of borrowing is high. I saw in the poll that was just pulled up, you see, most of the financing that we have available today, year on year, we attend the AfrExim, we talk to Nexim, but the question is, how can an average exporter, who is, currently maybe playing in the informal sector, afford, this loan that is available? They do not even meet the requirement. So how can we begin to structure export financing to cater to the informal sector that is driving the export, and see how we can capture these informal people, export practitioners into, in a formal net, and encourage them to export even more, and we brag it out, talent, given our demographic advantage. You see that, we see improvement in Afrobeat, we see that in Nollywood and all of that. How many of this do we, how effectively are we capturing data, and how fully are we harnessing, this orange economy to even drive, development across, the continent, and be the leader and the giant of Africa that we claim to be, or that we are seen to be? Because I believe if Nigeria gets it right, Africa will get it right. So the potential is there, but of course we are definitely underperforming, and I cannot say we are actually ready. Let me yield the mic, Dr. Sanford.
Thank you very much, David. I think that was quite exhaustive in terms of, how you have dealt with these problems. What I hear you say clearly is that there is a huge gap, right, between our potential and where we can actually be in terms of performance. And all of these bottlenecks that you have highlighted, I think there is, of course, the structural part, right? And of course, like you eventually came to the financing part. Right. So let me test this from a financing perspective. And Scott, I'll come to you now. From
Sure.
your experience, what would you consider to be the actual driver for your credit decisions when dealing with Nigerian counterparties? I say this understanding that typically the way your structure is that you fund local companies in your location, but then you take security over the assets when they are imported into Nigeria, right? But in terms of when you make your credit decisions, how do you deal with the risks of the Nigerian counterparty, so to speak? And what will typically kill a deal for you?
Yes, thank you. Thank you for having me. It's a pleasure to be here. And there's so far some great insights. And David, that was a great comprehensive response. And there's no one key factor, I would say, in when we're doing the credit assessment. But as an international lender from Canada, we were financing the exports into Nigeria. And we talk about export readiness. I can say import readiness, but it's really international trade finance readiness. Like the companies that we support have to have some level of track record and sophistication in international finance and international trade. And first and foremost, it has to be a strong business, right? It's going to have to be a profitable business for the last 3 years. However, if it's not, we can find a related entity that could act as a guarantor. So there has to be one or two obligors. At least one of them has to be a strong business where it is credit worthy, where we're not going to take any haircuts on the credit worthiness of the company. Because what we like to say is, we like to make a return of our money, but we also like to have our money returned to us. So it has to be repaid, and that's always the goal. And so with some things we look at, the obliger itself. So like what's their track record? Do they have audited financial statements from a top tier accounting firm? Are they reporting in international reporting standards already? So are they already prepared to be underwritten by international companies, and reporting in international standards helps that quite a bit. I will say, given the jurisdictional risk that has been brought up, the structure of the deal does a lot of the heavy lifting. You can talk about the credit, which is very important, but the structure of the deal is ultimately what gives the lender and the ECAs a lot of comfort as well. A big factor, we usually typically lend in US dollars. So obviously, does the Nigerian entity have a pathway to purchasing hard currency, US dollars? What do they have a history of doing so? We've had some challenges along the way with some customers, but so really proving to us that you have the ability and the access to the US dollars, because that's what we need to be repaid in. We do consider the sovereign risk of Nigeria as a kind of like not just a macro backdrop, but we do consider that as like an operational risk, mainly around when we're shipping you a piece of equipment, or if this is a new industry or sector you're getting into. Well, what regulatory bodies are you looking to gain approvals or licenses? How long will that take? There can be some bureaucracy risk as well, as in every country, but we've experienced that in Nigeria as well. And then we can go on to again, banking relationships. We will typically ask for a bank reference letter. Do you have essentially a referral from your bank, from a top tier bank in Nigeria that you've worked with, and you have a good history with, good standing, that provides us with a lot of comfort as well. And so those are some key factors. But the honest reality is that there's no single factor that is decisive. It's the combination of the obliger quality, structure, and risk mitigation tools that help give us comfort. And as David touched on, and the opportunity, and everyone's touched on the opportunity. Nigeria is a market that we actively want to be in, given the trade flows, the deal sizes, just the size of the country and the resources and the opportunities. But it does require structuring discipline from the outset, rather than trying to paper over credit concerns later.
Right. I mean, I thank you very much, Scott. What I hear you say really is that the capital is available. Perhaps it then has to do with the alignment in terms of what, the borrowers or the obligors rather meeting up to the requirements for being able to draw down on that capital. So let me say, I'll bring you in here, right? With what Scott has said, and I know that he has sort of suggested that some of the things he has mentioned here are pretty much legal, right? And so I want to check in with you. Oh, sorry, I'm not sure. Okay, I'm not sure. Can anyone hear me? Can everyone still hear me, please?
Yeah, we can hear you.
It says my connection is unstable. All right. Okay, great. Thank you. So James, my question really is, from where you sit, what do you think should be in place from a legal and structuring standpoint, so to speak, before this capital can flow? What makes this? What do you expect to see for this project or this exports transactions to be bankable?
Thanks very much, Sanford. And I'll just take this opportunity to thank. Can you hear me?
Yes, I can hear you. I'm not sure.
Yeah, so thanks very much, Sanford, and I'll take the opportunity to thank the Denton's team as well for having me be part of this conversation. It's a pleasure to be part of this distinguished panel. I'll start by situating the role of DFIs in export finance, because when we talk about traditional export finance, we're talking about the work of ECAs in supporting their exporters to sort of do international trade and mitigate the risks. But the mandate of DFIs is different, because from our perspective, we are focused on development impact and on supporting the countries that are member countries, which for us in the FDB is our 54 member countries. So we deal with we interact with export finance indirectly. So we finance the companies that produce the exports. We support trade through financial institutions which act as our intermediaries. So we provide them with risk participations, with transaction guarantees, with different risk protection instruments that basically reduce the risk so that they can then interact with the borrowers who are the exporters. And so because of that, we also the other thing that we do is that we co-finance with ECAs. So in a typical project finance transaction, for example, if we're financing, say, a port or a hydropower plant, there would be export finance elements of that, because there will be equipment that are being imported into the country, right? And then so there could be an ECA tranche which is dealing with that export element, and there could be a DFI tranche which is dealing more with the project finance elements of that. So so in terms of a DFI's role when we talk about export finance, it's really us supporting sort of the ecosystem, whether of export finance, as opposed to actually doing pure traditional export finance the way an ECA would do it. So with that, with that framing, because I think that framing is important to actually come back to answer your question. The issue about what makes an export finance deal bankable is more than just the element of the export contract itself. You're looking at the broader picture of bankability generally, and when you think about it, whether it's corporate finance, project finance, export finance, bankability is really the same. And at its core, it's about certainty of cash flow, certainty of enforcement. So what we're trying to see is a clear path from disbursement to repayment. And in a situation where there's a potential downside scenario, lenders would like to see a credible and enforceable recourse pathway. So that's sort of the very general point about bankability. And so if we come down into sort of more nitty-gritties, we want to see a predictable and enforceable cash flow. So we want to make sure that we know that from as the contract, the underlying contract, it has buyers that are credible, and that the payment obligation is without set-off, without counterclaim, very clear that there is that obligation to pay. And that then includes all the approvals. So in the Nigerian scenario, whether it's debt management office, whether it's the legislators, every type of approval that is required, is in place, right? So that gives lenders comfort. And then we also look at the robust risk allocation and mitigation. And of course, that has been discussed a lot, because you can't talk about export or trade finance without talking about risk. There's all kinds of risk involved. There's performance risk, payment risk, political risk. And that's where we see the likes of letters of credit. We see political risk insurance and the kind of guarantees that ECAs give. All of that come into play in making sure that there's risk allocated, and where, that's all, when it comes to risk mitigation. But even in terms of the allocation of the risk, the risks have to be allocated to the parties that are best placed to handle them, right? So, when we're looking at, the contract, we're making sure that whoever has is the best party to handle it has that risk, so that lenders can see that there's a whole we're entering into the transaction knowing exactly where the risks are. And of course, in a downside scenario, looking at the legal enforceability across jurisdictions. So whether that is a clear governing law, clear dispute resolution mechanisms, whether it's court or arbitration, but that all of that is clear. And from a legal, purely legal perspective, we're looking at making sure that there are legal opinions which confirm the enforceability capacity of the borrower, and the fact that there are no regulatory approvals that have been missed, so that everything is really coming back to the certainty point. The other thing is security and credit support. We know that in a lot of jurisdictions, sometimes enforcing onshore security can be difficult. And so looking at the security options that are offshore, right? So security over accounts, assignment over receivables, direct, payment instructions that are irrevocable, those types of security that, allow lenders to be able to sort of have more faith in, in having more comfort. As Scott mentioned the thing about the point about hard currency. So if contracts are going to be sort of disbursed in dollars, you want to make sure that there's a clear path to receiving dollars back, and of course that's a whole point. Whether it's hedging or whatever it is, but then that all of that is clear. And then, in the contract itself, I think based on the underlying, the underlying contract in the finance agreement, it has to have the mandatory and events of default that are tied directly to the underlying contract. Because of course, as soon as the underlying contract is no longer in place, the financing, the link to cash flow becomes dicey, right? So making sure that, sort of the obligations are back to back, so that, wherever, the underlying contract has, sort of has any type of issues, that the, whether, if there's a default on the underlying contract, that ties through to the main, to the financing agreement, right? So I think everything, it's really, coming back to sort of what the core is. The core is really just ensuring that there is certainty, and when those types of financing agreements are being entered into, all of those points, that have mean that a lender is looking at the agreement and it's tied. It's back to back. All of that lends itself to the bankability, and in a potential scenario where things go belly up, there is that very clear path to making sure that there's enforceability and there's recourse. So that'll be it from me. Thanks.
Sanford, you need to unmute yourself.
Oh, my apologies. I had gone on and on about EMS's comment, and I was just trying to point out how it cannot be overemphasized that legal certainty is important to a lender, right? Without legal certainty, transactions simply don't close, right? Sometimes there may be commercial risks, I stand to be corrected, but there could be commercial risks. But unless there is a pathway to a lender, being able to receive repayments, right? It's hard to see those kind of transactions close. Okay, thank you very much, Yemisi, and I think that was really, really helpful. And I think I'll just bring Steve in here now. Steve, you work with an ECA, and I would imagine that there should be a perspective on all that has been discussed from an ECA standpoint, right? But maybe I should start with asking you where you see export finance heading over the next few years, and perhaps how markets like Nigeria should position themselves. Maybe speaking from your very recent, quite laudable deal in Nigeria, it might be helpful to just get a sense of where we see where we see export financing going in the next couple of years.
Thanks, Sanford. So in answering that question, maybe let me just go back a bit in history about ECA financing into Nigeria since 2009. On the OECD reporting that we have access to, there's been 187 transactions in Nigeria since 2009. And so on average about 11 transactions a year. But it's quite interesting to see that the median value of those transactions over that period of time has been relatively small, $2 to $3 million. Now that may be small for some of the larger deals like the one we announced last week, but it could be quite a lot of money for Nigerian companies looking to export. Now, I think it's also interesting to sort of pick up on a couple of comments made earlier. In the structuring of some of those deals over the years, we've seen ECAs...
With apologies, I don't know if you're able to, I'm not sure everyone can hear you loud.
Okay.
Is it possible to just to get a notch higher?
There's an echo as well. Maybe you want to look into that.
Okay.
Can you hear me any better now?
Not really.
Okay, let me try this. What about this?
Okay. Maybe you should just keep speaking. I think, yeah, fantastic. Good.
So in terms of the structuring, what we've seen is ECAs getting comfortable with probably about 1/3 of those transactions being guaranteed by banks where there's been a local company being the borrower. So it goes back to this whole issue of the bankability. And I think it's important to remember that ECAs are not there to make a bad transaction bankable. They are there to make a bankable transaction much more attractive in terms of bringing in cheaper capital. And it goes to Yemisi's point about the structuring and the bankability. The deals have to be bankable before an ECA comes in. Otherwise, an ECA comes in with their credit enhancements, and that guarantee is going to be pulled. That's not good business for anyone at the end of the day. But in looking at those deals since 2009, they have been predominantly private sector. There have only been 2 federal government transactions and 1 state-owned enterprise with Nigeria LNG. And that's reflective of the legislation in Nigeria for the federal government under the Fiscal Responsibility Act that has historically sort of encouraged them to either go for concessional financing or capital markets. And we've seen in the last 4 years, the Debt Management Office include within their debt management strategy accessing ECA financing liquidity, which they hadn't done before. So when you ask me about what does the future look like in Nigeria for ECAs, it's certainly a lot more exciting and interesting as the federal governments are now looking at that pool of liquidity from the ECAs. And why are they looking at that? Again, if you look at the sort of types of capital available, you've got the concessional, grant funding, ECAs, Eurobonds, and then commercial banks. And there is two graphs, there are two lines along that axis. One is cost, grant funding is zero cost. And as you move across from grant to concessional to ECA to Eurobonds to commercial banks, the cost curve goes up. But the second line is one of conditionality. So if somebody's giving you free money, they're going to put a lot of conditions. Whereas if you go further down the line, towards the commercial banks, that conditionality reduces. And this is where it's interesting for ECAs. It's at the nexus of both the cost and the conditionality, where we can get really attractive financing with relatively little conditionality that comes with that financing. And so I think as in the years ahead for Nigeria, we're going to see a lot more use of ECA financing, certainly for the federal and state government capital investment programs, and for the private sector as well. We will see a sort of continuation of an ecosystem that's supporting SMEs buying capital goods or services for their investments, and hopefully for the exporting goods out of Nigeria.
Thank you. Thanks, Steve. I'll just stay with you a bit more. And, speaking with you gave me certain insights, and I'll just dwell, just to get a better understanding of how UKEF would, at what point they are willing to come into transactions, right? I know, for example, so while speaking with you again, that UKEF increases or at least maintains its willingness to support transactions precisely when commercial lenders are reducing their exposure due to perhaps heightened risks, right? I was wondering if you have seen instances where UKEF has deliberately increased exposure in markets perceived as high risk because of your counter-cyclical mandate.
So we haven't. We have a risk management framework that ensures that we deliver both parts of our mission, which is to ensure that no viable export fails through lack of access to finance or insurance. But the second part, operating at no net cost to the UK taxpayer. So we're deploying UK taxpayers' funds to issue guarantees and direct lending. And the risk framework ensures that we operate at no net cost to the UK taxpayers. So we don't necessarily increase our capacity for a market because it's much riskier. Risk framework already determines that. But as a risk taker, we are there for the long term. When you think about transactions that we're in, we can be in those deals for up to 26 years. So we're not just looking for the here and now, but we're looking on a much longer horizon in terms of the risk. But what we have done, and I've seen examples of this in West Africa, is where we see a market failure. So where we provide a UK government guarantee that gives confidence to the banks to support a transaction with their cheaper capital, so that in the event the borrower fails to repay that loan, they can call on our guarantee. But we do see some markets where banks will not go in because they still feel it's still a little bit too risky for them. And where we see a market failure of a lack of liquidity, we have actually mobilized additional direct lending from the UK Treasury to ensure that we fill that gap, to ensure that the transaction moves ahead. And I think it's also important just to remember for ECAs, not all ECAs are equal. The product the UK Export Finance offers gives banks 100% cover of the amount that we're guaranteeing. But a lot of the ECAs are only providing 95%, which leaves the banks with a 5% exposure. And so it tends to be more expensive with the other ECAs that are not ECA-backed financing, where they're not providing 100% cover. And additionally, additionally, it will also mean that some deals, the banks won't go in because they're not prepared to take that 5% risk as well. Whereas with us, they have the confidence of 100% cover on the amount that we're backing.
Right. Thank you very much, Steve. I think that was quite insightful. Yeah. Yemisi, can I just come back to you? And again, talking risks, and of course, we did talk about security. But let's move away slightly from borrowing by privates to borrowing by sovereigns, right? One of the things that we see, for example, in Nigeria, is that the law protects certain government assets from execution, even after a waiver of sovereign immunity has been signed by the Nigerian government. From a legal structuring perspective, I was sort of wondering how we should, as lenders or as AFDB, how do you deal, right? Or how do you approach this kind of constraint to ensure that you have meaningful recourse in the event of a default, especially where you have a sovereign-backed transaction? And if something you want to speak to.
Yeah, sure, Sanford. So sovereign immunity basically differs between immunity from jurisdiction and immunity from execution. So in a lot of situations where we, for example, in the previous examples that I gave, where we are financing, say again, a road or an airport or ports, we know that even though we have land security over such the assets, the underlying assets, that at a time of potential enforcement, that we really cannot enforce on those assets. For various reasons. Firstly, there will be government assets. Even when we have the land ownership is usually just temporary. Even if it's a number of years, it's still going to end. So these are not assets that lenders are even trying to enforce on. They're government assets. So what would usually happen is that the building of the structuring of the transaction builds in security, where we have security over the contracts that actually bring out the cash flow. So in that scenario, like I was saying to you, a lot of the way we get involved with ECAs is usually with a lot of projects, for example, where there's an ECA element and there's a project financing element. So in those types of transactions, we will take security over. We'll have step-in rights, right? And step-in rights are where the lender can go in, replace the borrower. So the borrower has a problem, gets into default. There's a stay period where the contractor cannot cancel or terminate the contract. And in that time, the lenders try to get somebody else to replace the borrower so that that asset continues to generate cash. Because lenders are in the business of lending money. They're not in the business of operating assets or doing, trade or export or whatever. All they want to do is get their money back. So an asset is only useful to us when it can generate cash. And the way, or we get, and whether it's through operating the asset or getting an alternative buyer, right? So in a lot of those types of projects, we rely on those types of security, whether it's security of direct agreements where we have lender step-in rights. That helps us to continue to generate money from the project, even an enforcement scenario. And also offshore security, like I said previously, right? So when you're getting security over the account. So for a belt and braces approach, of course, you would take onshore security over the assets themselves. But that practical enforcement of that is going to be difficult given the connection with the government and give government assets. You can't, if you enforce over a road or a bridge, that that's not going to happen, right? From a lender perspective, if lenders, so that these are government assets, you get security over, the more, intangible assets, whether security over receivables through the contract, security over accounts, security over, and then, obviously you lock accounts as well. So there are obviously all the different types of way in which the cash flow itself is what is really providing you with the security. We've had a situation where there was immunity from execution, and we were doing a transaction in Nigeria, and it was agreed that there would just be some very specific liquid treasury bills that would be our security. So that way, it was a liquid asset that could be sold to repay us, right? So you have those exceptions, but a lot of the time, we get better security from basically taking security over receivables or contract or things that would actually generate money, instead of trying to fight an uphill battle with the government for assets that that can never be given to you, or would not even have any value unless it was generating cash flow.
Thank you, MC. That's clear. That's understood. Thank you. So I will just open up this so that we just have some sort of across the panel. We could just have just a bit of a quick conversation. And maybe I'll ask Scott, if you don't mind, to go first. So where do you see transactions fail more often? Is it at the point of the credit or at the point of structuring?
Well, they fail most often. Well, yeah, I mean, the first thing we do is a high-level credit overview, credit assessment. So, like, we ask for 3 years of financial statements. And as I mentioned, the obligor or a guarantor, one of the obligors on to the party to transaction has to be a strong, profitable business with clean audited statements. We need to be able to look at those audited statements, see that they have a track record of profitability, because you cannot price the risk you cannot see. So I think I can go further on other deal breakers, but first, high level is that we do look at the credit first, and then we work on the structuring, which is the heavy lifting. But you won't get to the structuring if your track record from a successful business perspective isn't there.
Right. Steve, I mean, what do you think about this?
There are many reasons why transactions fail. In my role, you learn to say no 101 different ways very politely. So I think, first of all, some of the areas that I see failure is that ambition is not connected with reality with some of the transactions that are put before us. The second area is sort of, as an ECA, a UK ECA, we are concerned to ensure that there is enough UK content, and it's people understanding what they can really buy from the UK. And when I say buy from the UK, goods or equipment that are manufactured in the UK, or services undertaken by people normally residents, rather than something made in China bought through a UK company that doesn't meet our requirements. So it's people thinking through the UK supply chain that meets our policies. And then the other area of failure that I see quite often is that people do not work with banks or professional financial advisors to structure the project properly in the first place. And I would always encourage people to engage with a bank first, certainly for the small corporate deals, because they need to do the structuring. As an ECA, we use the banks as agent banks. They work on our behalf, and therefore they've got to be comfortable with the deal before they present it to us. By the time we get to our credit committees, we would have done enough scrubbing to say whether this is viable or not, and told people if it wasn't. So our failure rate at credit committee is very low because of the rigor that we apply in the due diligence process.
So interesting. Steve, maybe I'll just take you up again. And I know that we sort of had this conversation at some of the forum. What's your opinion about this ongoing war or crisis, global crisis, and how do you see this impacting export finance?
Okay, I'll comment on the second part of your question rather than my opinions on the war itself. But look, the conflict that's going on in the Middle East at the moment is pretty serious in terms of the multifaceted impacts it's having on the global economy. And I don't think yet we truly understand the full implications. Resource-rich countries like Nigeria, in terms of oil, will at a macro level benefit from a much higher oil price than they had budgeted for. This year's budget was $64 a barrel. We're seeing much higher prices now. So at a macro level, it will be not bad for Nigeria. But at the street level, it's going to be inflationary, and some of those impacts we're not going to feel until next year. So, for example, fertilizers. A large proportion of the world's fertilizer is manufactured in the Middle East. That's not being come towards the end of this year, when they need to buy new inputs, they'll find scarcity and they'll see increased prices. So, we will see cost inflation at consumer levels moving forward. There are some, and there are far wider impacts that, as I say, were yet to be assessed. And there are some risk professionals that feel that this conflict is actually far worse as a shock than COVID was, or even the 2008 financial institutions crisis. So, we do need to be mindful of that, and prepare for some choppy waters in the year ahead. But when there's choppy waters, as you pointed out earlier, ECAs are counter-cyclical. So when times are tough, people go for the comfort and the safety of the credit quality an ECA can deliver. So I expect that we're going to be a lot busier in the year ahead, but it doesn't mean it's going to be an easier environment to be working in.
Thank you, Steve. Thank you. I see that other panelists were nodding at Steve while Steve was remarking, so I would imagine that they seem to agree with him on that point, on the points that he has raised. And so perhaps what I will just do then is to say, just to check in with everyone, what your parting words. I see that we've actually done well over an hour on this webinar already. Yemisi, would you mind if I start with you on your parting words?
So thanks very much for the opportunity. I think for my parting words, I would just say that export. It sounds like Nigeria is ready, or at least preparing to get ready for export finance from the AFDB's perspective. We again are always supporting the trade ecosystem. For us, we don't have we're not tied to any types of exporters, because we have to represent the interest of all of our member countries, and particularly focusing investments in our 54 member countries. And so we are always ready to support the intermediaries that help us to give comfort to trade finance, providing letters of credit to confirming banks. We provide trade guarantees, and we provide trade finance lines of credit for banks which are lending to exporters and those who are doing trade. So I think the African Development Bank is always willing to support trade and export finance. So thanks very much.
Thank you very much. Thank you, David. Like to hear from you.
Thank you. Thank you very much. Can you confirm that you can hear me?
Yes, loud and clear.
All right. I believe that conversations like these are quite necessary as we, deepen our readiness and preparedness for to leverage, the advantage that we have in terms of deposit of natural resources, in terms of, demographic advantage, in terms of, large markets. And if we fail to develop our export potential, and thank God NEPC is here, Nigeria stands the risk of becoming the dumping ground for Africa because we are the largest market. So the work we need to do is to start seeing how we become very intentional. I see what Lagos State is doing at the subnational level to establish Lagos Finance House, and to see how, and we hope that we can begin to see replication of this at subnational level, and work with local government and or state government to structure financing that can serve their local assets development. Because as we rightly established, every state has exportable product. Academically, I agree with me. NEPC did the one state, one product project for several years. I think under Segun Awolowo, God bless his soul. But the truth is, what did we get out of that? So we need to actually now start getting very intentional. We see, I mean, there is improved FAC. At the World Trade Center level, one of the things we are doing now is to say governments to help them structure, financing for export. Later in the month, we'll be in the US helping, set up Homeland Capital for subnational development, where we're looking at our growing, diaspora community as a country to attract financing, for especially for the informal sector, that can attract, maybe single digit interest rate if possible, and then make financing available to people who are the real exporters as well. So this would be my thought. We need to actually continue to drive to advocate to structure financing that can cater to the people at the bottom of the pyramid, and of course especially the informal sector. They drive the highest volume when it comes to cross-border trade, and we can capture them in the net and see how we can encourage them to do more. Yeah, that would be it from me.
Thank you very much, David.
Thank you.
Thank you. Scott, can I ask that you do this in a minute?
Yeah, I'll do it in a minute. I'll just say, in terms of, there's lots of opportunities. So in terms of readiness, I would say if this is something a company is looking to explore, I would say get your financial house in order before you need the money, not when you need it. Bankability is something, a status you achieve on the day, is not something you get on the day you apply for financing. It's something you build over years. And the best time to prepare for international financing was 3 years ago, and the second best is today.
Thank you. The best time was 2 years ago.
I'll leave it with that. No, I'll leave it with that. There's a minute.
Thank you. The best time was 2 years ago, and the next best time is perhaps today. Thanks, Scott. Steve, would you want to just give your final thoughts?
Just to sort of extend on that theme from Scott. You really only have one chance when you present an opportunity to be financed. So I would encourage people to take the carpenter's approach: measure twice and cut once. Proper preparation prepares a much better receipt. Great.
Thank you very much. Thanks, Steve. So just to sum up, my key takeaway for me here from the panelists really is that, of course, there's the demand. Of course, there is capital. Of course, we see policy momentum. I think David made that point. There's policy momentum within the system. But you see, unlocking this at scale requires some sort of alignment, right? Alignment of structures, risk allocation, regulatory and legal clarity. I think ultimately the question then will be whether Nigeria can the question is not whether Nigeria can export more, actually. It is whether we can finance those exports in an intelligent manner enough for us to scale them. With these, that's my parting words. I'll say thank you for joining us in this webinar, and I will then leave this with Lola Coca.
Okay. All right. Thank you very much.
Thank you.
Thank you very much, Dr. Sanford, and thank you to all our speakers for their contributions. Architect Benedict Itebe, Mrs. Yemisi Oniori-Malade, Mr. Scott Rambu, Dr. David Opeyemi Oke, and Mr. Stephen Gray. Your insights today have indeed been very invaluable, and we are deeply grateful for your time. We thank everyone else who has joined us. Thank you for staying with us through the session. We hope that the conversation has been worthwhile and that you're leaving with a clearer sense of what is possible and what is required to unlock export financing for your businesses and your business's support. Generally, we have explored the evolving landscape of export finance, its challenges, the emerging opportunities, as well as the innovative tools reshaping how businesses access capital, manage risk, and expand into new markets. The insights shared today by our speakers underscore one very clear message, which is that export finance remains a critical driver of growth, competitiveness, and resilience, especially in an era of shifting global trade dynamics. So just a few things to note for all our participants. A recording of today's session will be made available, and we encourage you to share it within your network. And the more businesses that can access this conversation, the better position Nigeria exports ecosystem will be. And if today's discussion raise any specific questions that you'd like some clarification on around structuring, documentation, regulatory compliance, or accessing finance, our financial services team at Dentons ACAS-Law is available and will be happy to assist. And please do not hesitate to reach out to us. Thank you very much to everyone that has joined us. Unfortunately, we were not able to take questions because of our time, but we do appreciate you for taking time out to be part of the conversation. We look forward to welcome you to future sessions as we wish you every success in your export journey. Thank you, everyone, and good afternoon. Thank you.